Welcome to this week's Dividend Cafe. It is our pleasure to come to you this Thursday evening. Right here in the middle of July, and we are completely flat on the week, like within a point on the Dow from where we closed last Friday. So we had been up 9 days in a row in the Dow Jones Industrial Average, and that ended today. We were down about 70, 80 points, and we had been up 70 or 80 on the week. So we ended up today flat for the week, and then of course we have Friday tomorrow. But like I said, it's been a 9-day winning streak, which is one of the longest in Dow history, not the longest though. So as far as where we are with the market, really earnings season is kind of the major thing we're following right now. We don't think that there's any kind of macroeconomic imminent news or information or data that will drive things in the next few months, more than likely. The election is not a huge consideration right now. We think that more and more, the market sentiment anyways, is of a status quo result with Republican leadership in the House of Representatives and Democratic leadership in the White House. Probably the events of the Republican convention this week have not done a lot to change that at this point. But those things are fluid. The Fed is not likely to act anytime soon. There's still a possibility of one rate hike at some point later this year. I would guess it to not be till after the election. I don't think that would happen in September, but even that's possible. Along those lines, this is kind of the issue that is not going away anytime soon, and it's the sort of shoe that could end up dropping with this particular market rally we've been experiencing really since the middle of February, because of that little Brexit hiccup, the 2 or 3 day interruption there. You could say it's only been about a month, but other than that, it had been going on for several months. And this rally, in my opinion, gets interrupted whenever the Fed indicates they're going to raise rates. And the dollar will rally on that news. And the dollar rally will then distort markets with emerging markets and commodities and cause a certain degree of risk-off environment. I don't think it'll last very long, but I think that's likely to happen again whenever the Fed talks up their next move. But most of the time over the last several years, when they've talked up a move, the market response to it has caused them to not make the move. And that's the irony of what we're dealing with. That's my just personal take as to what would end up interrupting this particular rally. Oil prices this week are kind of bouncing between 44 and 46. Not a lot of movement there. Which is interesting because emerging markets have really enjoyed a pretty significant rally these last few weeks, and oil is not. Now, emerging markets have enjoyed a nice rally even as the dollar has actually advanced, but the dollar is not really advanced against a lot of emerging markets currencies. It's more advanced against euro, and then more recently against yen. And so that kind of dispersion of results for the dollar creates a little bit of ambiguity in how commodity prices like oil that are denominated in dollar will react. So we're not feeling a lot of conviction one way or the other right now about the next direction of the energy sector. The one thing I point out in the written Dividend Cafe this week I'd share with you now is this. High-yield bond spreads have not really extended very much. And to the degree that oil prices dropping should have caused another contagion effect of fear of defaults in these energy-related bonds. That's what happened in January and February to a pretty dramatic degree. The lack of follow-through in the high-yield bond sector causes me to believe that there isn't a lot of fear that this oil sell-off has more to go. But again, those things are hard to say for sure. Overall profit season, earnings results, we're only about 20% of the way through. Roughly 75% of companies have beaten earnings expectations. More important than that, it's as of right now, the numbers are changing every day. 57% of companies have beaten on top line, on their actual revenue sales figure. That number was below 50% last quarter, I think about 44%. So that's a pretty meaningful increase. And a lot of the names that we really love and believe in are some of the names that have been doing quite well this quarter. So we're obviously happy about that. In concert with a successful earnings season, where we're seeing dividend growth announcements, we're getting very excited. And a lot of the names doing best are names that are indeed proving it with dividend increases or are already themselves robust dividend payers. We're seeing some names that are becoming stingy on dividend and yet still announcing certain stock buyback stuff. And we're not really crazy about that. We're watching some of it. We love stock buybacks when they're in concert with a dividend growth strategy. But when one is used as an excuse to replace the other, particularly stock buyback, instead of dividend payments to us shareholders, we don't care for that. And we can defend that thesis, by the way, quite fluently. So I'm going to leave it there for the week, okay? We are in the middle of earnings season. We have a long way to go still. That's driving markets at the moment. Not a lot in politics, not a lot in Fed activity yet, and not a lot in the macro economy. So bottom-up company news drives things. And then we continue to watch oil and watch the high-yield bond market, see where risk sentiment goes. Let's leave it there. Please reach out with any questions. Have a wonderful weekend. Thanks for watching Dividend Cafe.